This show is part of One Place, a daily network of focused briefings across the stories people follow most.
Welcome to our daily roundup. We are diving into a heavy news day, from geopolitical tensions shaking global finance to a tragic aviation accident in New York and the latest in tech culture.
Gold prices crash 10% as oil hits triple digits.
Global stock markets enter correction territory following Trump's ultimatum.
The Strait of Hormuz remains the epicenter of market turmoil.
A fatal collision at LaGuardia Airport leaves 2 pilots dead.
Andrej Karpathy explains why he maximizes his AI token budget.
Investors pay massive premiums for shares in defense startup Anduril.
Zomato raises platform fees to boost margins despite competition.
Return-to-office mandates and AI are pushing women out of work.
Indian penny stocks defy the crash, with massive monthly gains.
Veteran investor Porinjuveliya sees opportunity in the current panic.
First, the gold market. The gold market is witnessing a historic collapse today, with prices plunging over 10% in a single session. This massive sell-off comes as the US-Iran conflict reaches a boiling point following Donald Trump's 48-hour ultimatum to Tehran. As tensions flare, WTI crude oil has surged past the $100 mark, touching an intraday high of over $101 per barrel. This spike in energy costs has supercharged the US dollar, creating a toxic environment for precious metals. Investors are fleeing gold and silver as the dollar index approaches the 100 level, a significant jump from its pre-war position of 96. It is a classic inverse correlation playing out in real time.
Market experts like Sugandha Sachdeva from SS Wealth Street are highlighting how this geopolitical escalation is completely rewriting the monetary playbook. Previously, the market was pricing in interest rate cuts from the Federal Reserve, but the energy crisis triggered by the Strait of Hormuz situation has reignited inflation fears. Now, the narrative has shifted to a higher-for-longer stance, with the possibility of actual rate hikes if these pressures persist. This shift is what's really dragging gold down. The yellow metal is navigating a complex environment where geopolitical fear usually drives it up, but the resulting dollar strength and hawkish central bank expectations are pulling it in the opposite direction with much greater force.
Next, global stock markets. The fallout from the Iran ultimatum is hitting equity markets just as hard as commodities. The FTSE 100 and the Pan-European Stoxx 600 have both officially fallen into correction territory, meaning they are down more than 10% from their recent highs. The selling pressure started in Asia, where South Korea's Kospi slumped by over 6%, and Japan's Nikkei dropped 3.4%. Analysts are warning of an escalation trap where neither side has an incentive to back down, and the costs of the conflict are increasing daily. Investors are waking up to the reality that this could be a long-term disruption to global energy markets, which is poison for stock valuations across the board.
In the UK, the situation is compounded by domestic economic pressures. Traders are now betting on 4 interest rate rises from the Bank of England this year to combat the inflation being imported via high energy prices. This would bring the base rate up to 4.75%. We are seeing specific pain in the FTSE 250 as well, which is often a better gauge of the UK's internal economy. For example, Spire Healthcare saw its shares tumble 20% after takeover talks collapsed. Between the threat of a wider war and the certainty of higher borrowing costs, there are very few places for investors to hide right now as the global indices continue their downward slide.
Now to the Strait. The Strait of Hormuz has become the absolute focal point for the global economy as the conflict enters its 4th week. Brent crude is now hovering near $114 a barrel because Iran has threatened to strike electrical plants across the Middle East if the U.S. follows through on threats to bomb Iranian power stations. This is a high-stakes game of chicken with the world's energy supply at the center. Prime Minister Sir Keir Starmer is even holding an emergency Cobra meeting today after discussing the situation with President Trump. Both leaders agree that reopening the shipping route is essential for stabilizing markets, but the 48-hour deadline ending tonight has everyone on edge.
Analysts like Chris Beauchamp from IG are noting that investors are in no mood to wait and see what happens when that deadline expires. The continued selling of stocks and precious metals reflects a growing fear that each day this war continues, the chances of a global recession rise. Kathleen Brooks from XTB pointed out that this could be the pivotal week where we see who blinks first. If the strait remains closed, the inflationary impact will be devastating. The market is essentially pricing in the worst-case scenario right now, because the rhetoric from both Washington and Tehran shows no sign of a diplomatic resolution. It is a waiting game that is costing the global economy billions every hour.
Moving to New York. Tragedy struck LaGuardia Airport late Sunday night when an Air Canada Express regional jet collided with a fire truck during landing. we have confirmed that both the pilot and the co-pilot were killed in the accident. The aircraft, a CRJ-900 operated by Jazz Aviation, was carrying 72 passengers and 4 crew members from Montreal. According to flight tracking data, the plane was traveling at about 24 miles per hour when it struck the vehicle. Photos from the scene show significant damage to the nose of the aircraft. It is a devastating event that has led to the temporary closure of one of the nation's busiest airports, with dozens of flights being diverted or canceled as investigators begin their work.
The details surrounding the fire truck are particularly concerning. Reports indicate the vehicle was being operated by police officers and was responding to a separate, unrelated incident at the airport when it was struck on runway 4. While the pilots tragically lost their lives, dozens of others on the plane were injured, and 2 officers in the truck suffered broken limbs but are in stable condition. The National Transportation Safety Board and the FAA are now tasked with determining how a rescue vehicle and a landing aircraft ended up in the same space at the same time. For now, the Port Authority is warning travelers to expect continued delays and road closures near the airport as the investigation continues.
Shifting to AI news. Andrej Karpathy, a titan in the AI world and co-founder of OpenAI, recently shared a fascinating shift in his professional mindset. He says he now feels nervous if he doesn't use up his entire AI token budget. For those unfamiliar, tokens are the basic units of text that AI models process, and they essentially represent the compute power at a user's disposal. Karpathy explained on a recent podcast that he views these subscriptions as a resource to be maximized. If he hits a limit on one tool, like Codex, he immediately switches to another, like Claude, to ensure his token throughput is as high as possible. It is a complete reversal of how we usually think about digital consumption.
This isn't just a personal quirk of Karpathy's. It seems to be becoming a broader expectation in Silicon Valley. NVIDIA CEO Jensen Huang recently mentioned that he expects high-earning employees to be using hundreds of thousands of dollars worth of tokens. He even suggested that the size of a candidate's token budget is becoming a recruiting tool. The idea is that your productivity is no longer limited by how fast you can type, but by how much AI compute you can effectively direct. Karpathy compared it to his days as a PhD student when you'd feel anxious if your GPUs weren't running. In the modern era, if you aren't burning through tokens, you aren't working at your full potential.
Next, defense tech investing. The demand for shares in the defense startup Anduril has reached a fever pitch, drawing comparisons to the frenzy of buying Taylor Swift concert tickets. Even though the company hasn't finalized its latest funding round, which is expected to value it at $60 billion, investors are scrambling to buy shares on secondary markets. Some are reportedly willing to pay premiums of up to 40% just to get a piece of the action. This is highly unusual, as secondary market premiums typically hover between 5 and 15%. It highlights a growing divide where top-tier VC firms get in at the ground floor, while everyone else is forced to pay a massive markup on the sidelines just to avoid missing out.
This scalping of private shares isn't exactly welcomed by Anduril's leadership. Founders Palmer Luckey and Matt Grimm have been very vocal against unauthorized sales, even calling some firms frauds and bottom feeders. They argue that these secondary markets are rife with bad actors looking to profit off the company's hard work without adding any value. Despite these warnings, the supply-demand imbalance is staggering. Data shows that buyer demand is at 97% while sellers are only at 3%. When you have that kind of lopsided interest in a company building high-tech defense systems during a period of global conflict, people are clearly willing to ignore the risks and pay whatever it takes to get in.
Now to food delivery. Zomato is making a bold move to boost its profitability by hiking its platform fee by nearly 19%. The fee is moving from 12.5 rupees to 14.9 rupees per order. While that might seem like a small nominal increase, analysts at Bernstein India point out that it significantly boosts Zomato's margins, especially since their adjusted EBITDA per order is usually around 20 rupees. This hike actually makes Zomato more expensive than its main rival Swiggy. In a duopolistic market like India's food delivery scene, these two usually move in tandem, so many experts expect Swiggy to follow suit shortly. It is a clear sign that the era of subsidized delivery is ending, as platforms prioritize the bottom line.
What's interesting is that despite these rising costs, consumer demand hasn't really flinched yet. The platform fee currently accounts for about 3% of the gross order value, which seems to be a level customers are willing to tolerate. However, Zomato isn't pocketing all of that extra cash. About 60% of the fee is actually plowed back into the system as discounts to keep users engaged. On the quick commerce side, competition with players like Zepto and Amazon remains fierce, but the focus has shifted from aggressive price wars to expanding dark stores and product variety. For now, Zomato seems to have found a sweet spot where they can increase fees without triggering a mass exodus of hungry customers.
Next, workforce trends. A concerning trend is emerging in the labor market as women are beginning to slide out of the workforce after making significant gains during the pandemic. Data shows that the number of working mothers with young children fell nearly 3% in the first half of last year, hitting a 3-year low. There are two major factors driving this: return to office mandates and the rise of AI. Many women who found success with remote work are now being forced to choose between a grueling commute and their domestic responsibilities. When flexibility disappears, many are finding that the cost to their family's mental health and stress levels is simply too high to justify staying in a traditional full-time role.
The AI component is equally troubling. A report from Anthropic found that roles with high exposure to AI automation are 16% more likely to be held by women, putting them at a higher risk for layoffs as companies integrate these new technologies. This creates a double-edged sword where women are facing pressure from both management's desire for in-person work and the technological shift toward automation. Since women still take on twice as much domestic labor on average, the lack of systemic support for integrating work and life is becoming a breaking point. Without the option for flexible or freelance work, we are seeing a significant number of talented women opting to leave the professional sphere entirely.
Now to penny stocks. While the broader Indian stock market is reeling from the West Asia conflict and skyrocketing oil prices, a handful of penny stocks are quietly delivering massive returns. Some stocks priced below 10 rupees have surged up to 60% this month alone, even as the Nifty 50 suffered its worst decline in 6 years. Retail investors are often drawn to these low-priced shares in hopes of making a quick profit, but experts are issuing a stern warning. The real danger here isn't just the price volatility, it's the lack of liquidity. In a market crash, you might be able to buy these shares easily, but finding a buyer when you want to exit can be nearly impossible without taking a punishing discount.
Harshal Dasani of Ian Vassett PMS points out that for every success story like Suzlon, there are hundreds of penny stocks that end up delisted, wiping out investor capital. Many of these recent gainers don't have any fundamental business reasons for their rise. It is purely driven by speculation and volume. With the rupee at record lows and foreign investors dumping billions of dollars in Indian equities, the advice from professionals is to prioritize capital preservation. They suggest that retail investors would be much better off in large-cap funds or liquid assets rather than gambling on micro-caps where the house usually wins. It is a classic case of high-risk speculation in an incredibly unstable global environment.
Finally, a veteran's perspective. Amidst all the red on the screens, veteran investor Porinju Veliath is offering a much-needed dose of perspective. His message is simple: the war will end. He shared data showing that while geopolitical crises cause sharp, painful declines in the short term, they almost always turn into incredible buying opportunities in the medium to long term. Historically, the Sensex has seen average gains of over 17% just 6 months after a major crisis. Whether it was the September 11th attacks or the Lehman Brothers collapse, the pattern remains consistent. The worst of the panic usually happens in the first few weeks, followed by a meaningful recovery as the market adjusts to the new reality.
The data is quite striking when you look at the numbers. After the COVID-19 crash, the market gained over 80% in just 9 months. Even during the Gulf War ultimatum, which feels very similar to our current situation, the market saw 25% gains within 3 months. Veliath's point is that while the current volatility is scary, it is often the point of maximum pessimism that offers the best entry for long-term wealth creation. Of course, every crisis is different, and some recoveries are slower than others. But the overarching trend of the last 40 years suggests that staying calm and focused on fundamentals is usually the winning strategy when everyone else is panicking.
That is our roundup for today. Thank you for joining us for this briefing. We will be back tomorrow with more updates on the stories that shape your world.
Be sure to follow the show so you never miss a daily update. Stay informed and stay safe out there. We will see you next time.